Developers are bleeding. Pre-sale projects are down over 50% from historical norms, and projects are being canceled midstream. This is not just a construction slowdown, this is a construction crisis. Not only that, some of Vancouver's biggest pre-sale players are laying off staff as well as pivoting to Alberta during this slowdown. But here is the bigger issue. BC gets nearly 10% of its GDP from its 250,000 construction jobs, with over half of them coming from residential construction, and contractors and companies are already laying off people, and there's more pain to come here in 2026. This is not just something that affects housing, this also affects the ability for people to earn a living and provide food for their families. So what does this mean if you're a buyer, seller, or investor? I'm going to go through this article here to show up the seriousness of what's going on and how this is a bigger problem than just real estate, but the ability for people here in BC to survive. So the article I'm referencing here is from BC Business, launched on July 25th, 2025. And the headline reads, "Real Estate in Crisis Inside the Economic Meltdown Threatening BC Developers." It starts off by saying it wasn't that long ago when a pre-sale office opened for a new high-rise condo tower in Metro Vancouver. There'd be a lineup down the street of eager buyers jockeying to put down a deposit. But economic uncertainty from U.S. tariffs, interest rates, surplus supply, skyrocketing material and labor costs, rising municipal fees, and a crackdown on investor capital have dramatically changed all of that. Now we're getting to a position where developers cannot give their units away. I did a video not too long ago where one developer did a one-day 25% flash sale just to try to move product. There are a ton of projects that are being canceled and turned into rental properties because developers cannot move these units. One of the reasons why the pre-sale market has just collapsed is just to the lack of appreciation with recent projects and the fact that the rental market has just dropped like a rock. And you can see that here. If you were looking for a condo for a potential investment, you might be underwater cash flow-wise if you're carrying a mortgage on it, said Brandon Amagdonson, chief economist at the BC Real Estate Association. Rents were rising, but are now falling, so maybe you're not going to get the rent you expected or need on an investment, and price appreciation is just not there. So a lot of people who focus on the pre-sale market were a lot of investors. Rents were going up and up and up, and appreciation was also keeping up with that rent. So everyone thought that these pre-sale investments were going to continue to go on a bull run forever, and that has just not been the case. As we went through COVID, as these interest rates went up and up and up, the margins for investors completely evaporated. Also, with the province and the cities and municipalities around BC cutting off short-term rentals, a lot of those margins got even less and less. And as I bring up some of these rental charts to show you what's been going on here over the last couple of years, and you can see from 2019 to 2025, the last few years in terms of rent. So in 2019, the average rent was $19.27, and it went on a pretty fast run up to the peak in 2023, where rents were on average $2,743. Now in 2025, rents have dropped down to $2,495. This is on average, taking all segments here, a drop of around $300 a month. So when the rental rate has been dropping like this, property taxes have increased, your mortgage has increased, appreciation is essentially null. In some cases, you're actually underwater. This has been a huge problem for investors, which has forced a lot of investors to liquidate their units. And because the rental market is so soft right now, it just does not make sense. And that is a big reason why a lot of these developers cannot meet their quotas of hitting about 70% sold to get the financing needed to move forward with the projects. And recently, with the rental market being the way it is, I've never seen it be this soft, where you can go onto Marketplace right now and people will compensate you maybe a half month's rent, maybe a full month's rent to get you in for the year. I've had clients who have had vacancies in their units and eventually had to be forced to sell. They even were trying to advertise on platforms like Marketplace and paid advertising just to get people to look at the unit. And that is a big reason why we're obviously having this issue here, is because the margins don't work unless you're wanting to put down 50, 60% down to be able to cash flow these properties. It doesn't make a lot of sense for people to invest here in BC in real estate right now. I want to go over some charts here in terms of appreciation over the greater Vancouver market here. And, some investors can take a lower rent if rents aren't keeping up, if that appreciation is there for the long-term play. But as we've seen over the last couple of years, there has been really no gains. And when you have the combination of both of them, it just does not make sense to purchase investment properties here in Vancouver. So in the detached space, and I know there's not a ton of pre-sale market with the detached unless you're going out to the valley, or some of these other places, but I wanted to highlight it here nonetheless. So here in Greater Vancouver, you can see that, near the peak in 2022, 1.861 million was your average price point. Today, we're at 1.828. So you're underwater from where you were 3 years ago. So no appreciation. You're actually at a loss over 3 years of holding real estate, which no one thought that would be possible here in Vancouver. The apartment segment's a little bit better. You can see that, we hit a little bit of a top out here in 2024 at 715. It's dropped down to 700. But, if we look at that same time period back in late 2022, we're at around 700,000. Now we're at 702. There's really been no movement in terms of property appreciation over the last 3 years in the apartment segment. And when we go to townhouses, again, the same time period, around $1,030,000 in December 2022. And we're at $1,036,000. So in 3 years, you have about $6,000. So again, not really any gains whatsoever, especially when you put in how much your mortgage is increased and your margins are worse, definitely a lot worse than what they were in the last 3 years. So this is why it's very problematic and why I have quite serious conversations with people who are looking to be investors here, because unless you're willing to put down a lot up front, your cash flow and your numbers on a monthly basis just don't make sense. I know for myself, I have a couple rental properties. One cash flow is just a little bit. I have another one that doesn't do too well, but the strategy that I employed just for my kids, I have 2 young kids. I wanted to get some pre-sale properties, and even if someone would pay 80% of my mortgage on one of them, by the time we have that mortgage paid off, and if our kids are still here, it would cost me a lot less to pay a little bit out of pocket every month for my mortgage rather than waiting 20, 25 years. My kids want to get into the market. How much more are you going to have to put up front to help them? So I felt that this was a better option for me. But there are some strategies. But if you're just looking, just for a rental property, even before your principal residence, which I find some clients wanting to do, I just think you want to take advantage of your principal residence first. If you've done well in the stock market, you want to exit out of that and put into some physical property, and you can cash flow because you can put some more money down. I may have some time for that argument, but you can see here, we're not really seeing a lot of appreciation here whatsoever. When we look at some of the titans in the presale space, here with Rennie, the region's leading condo marketing group, made waves back in May, laying off 31 people or a quarter of its staff. West Group Properties, which is another big provider in the presale space, followed suit in June, cutting 12% of its workflow. And what we see here is over the last 8 months, we've seen a number of companies cutting staff. Only 2 have been public, said Sayedi. Rennie wanted to be upfront about the challenges. He added, if nobody talks about the reality, nobody understands how big a problem it is. So when we have some of these big companies that have been here for a long, long time operating in the presale markets, laying off staff, that just shows you how bad this is going to be. And it's a trickle-down effect. If we're not getting these units sold, it is affecting other people with how they can make a paycheck and put food on the table for their family. Moving down, you can see that residential condo towers typically require the presale of 60 to 70% of units in order to obtain financing. The vast majority of projects that have launched or gone to market are not getting near that. The issue is the cost of building homes is now more expensive than what 80% of the population can afford. So this is why we're starting to see a lot of these projects canceling. If they can't make that number, the project just won't exist. So I know that some other companies that have been long lasting here in BC, such as Mosaic, some of them can cancel the bigger projects and can fund from themselves some smaller townhouse projects or some smaller wood frame type projects. But the big high rise, which need a lot of capital, and these bigger properties, construction, concrete builds, they're starting to cancel because people are just not lining up to be able to make these minimums whatsoever. As we go to the next subheading here, peril ahead, and this is quite interesting. Metro Vancouver saw 1,472 pre-sales for high-rise concrete condos in the first 2 quarters of 2025, said Stefan Grenier, Vice President of Zonda Urban, the major pre-sale tracking firm. At that rate, the region is on track for a 20% decline in high-rise concrete pre-sales from 2024 and 53% from 2023. Only 1 concrete high-rise project launched in the second quarter. The region is on track for a 33% decline in all pre-sales wood and concrete this year from last, and pre-sales overall are down 50% compared to longer-term historical averages. That's a big collapse, obviously. So this is where, and I've highlighted before, we're going to start to see some of this catch up with us in the next 3 to 6 years in terms of housing supply. Right now, the only thing that's being built is purpose-built rentals. And for people who are wanting to have home ownership, you have a lot of options now, but because of things like this, if we're down 50%, and Canada's going to have to do a better job in terms of reimagining their immigration numbers, because we do need to have immigration in here to help propel our economy forward. There's going to be less selection coming up. And when we have a backlog in permits, when we have projects being canceled, to fill that void is going to take years and years and years. So already, as we are in a space where these projects are being canceled, just to backfill those is going to take a couple of years, not to mention trying to get these inventory levels up higher. I know that a stat that I read was for this year in the Greater Toronto area, there was something around the lines of 45,000 condos coming to market, and next year is going to be less than 5,000. So there is going to be a shortage, and this is what it's proceeding, and then these are the numbers here that we are looking at in terms of what's going to start feeding to that as well. And we know that single family homes are also at a 40-50 low in terms of permits being issued. So they're not building anything in terms of resale. And as we continue down this article, a lot of projects are being turned into rentals as well. So there is going to be a tipping point where we're going to start seeing an issue, but that's going to be a couple years down the road. Of the current 16,589 pre-sale units on the market in the second quarter of 2025, more than 61% are in the danger zone, where project pre-sales lag behind that 70% target. Some developers are canceling projects while others are converting midstream to rentals. The Curve building down in Vancouver's West End by Brivia appears to be teetering into insolvency, and Tangerine Developments flipped a 379-unit condo plan into rentals in Surrey last month. And West Group also did a similar thing in New Westminster. The fallout from this is something that is going to be felt for all of us. I mean, when we look at how BC has run for so many years, they have really relied on real estate at the forefront of making money for the province in terms of how we operate. So as we see here, the economic impact of a residential construction slowdown to be immense. There's more than $2.2 billion in property transfer tax revenue from real estate transactions at risk for the provincial government. During a record deficit year, it had budgeted an average 5.5 per annual growth in transfer tax revenue. That's not happening, nor is a budgeted jump in housing starts. And then here, as we talked about in the intro, 10% of BC's GDP is linked to its 250,000 construction jobs, half of which are residential housing, and they are starting to get layoffs, and there's going to be more to come in 2026. So, if the province isn't getting their golden goose in terms of the property transfer tax, it's going to come down to the taxpayers going to have to make up that shortfall. So this is where I know so many people are calling for this massive real estate collapse and would be really happy for something like that. But you don't really think of what the ripple effects are going to be. Even if you're not a homeowner or want to be a homeowner, you will pay the consequences for that. You could be losing your job if you're in construction. If we have a shortfall with these property transfer tax, and it's not an if, we can see that it will be, the only way to make up that money for the province is to increase our taxes. So if you want better healthcare, you're in the union and you want better wages for as a teacher or a nurse, wherever that may be, we need that money supplemented. And if it's not coming from something that they budgeted, it's going to have to come from us. So this is why housing has to be so uniquely handled. And a big collapse isn't going to be good for anybody. It doesn't matter if you're a homeowner, a renter, or anyone in that kind of facility. It will have an impact on you in some sort of capacity. So it's going to be really interesting to see where things move forward. So as we finish off the article here, we head into crisis measures. The development industry has long argued the numerous municipal fees, red tape, and micromanagement by local planners were unsustainable. When projects were still profitable, it was a nuisance. Now it's a crisis. And that's really the issue why we have this housing crisis. It's not the foreign money. It's not all these items. It's the lack of product that was able to come to market. It took way too long from application to rezoning to getting people into these units. If this was all streamlined so that it would just take maybe 2 to 3 years to get somebody into a property rather than 5 to 6 years or maybe even beyond that, and making the costs of development to developers so extremely high, we have really turned a lot of other developers who would like to develop here to other cities or other countries around the world because it doesn't make sense here. So the governments on the federal to the municipal level really need to change things around, because as we go through this article, we can see we're going to be having a housing shortage. And when new leadership comes in, the pendulum goes from one extreme to the other. Now everything that's being built is purpose-built rentals and resales are dropping. We should have a nice even flow of both of these products that represent the demographic of people living here. If all that's being built is purpose-built rentals for those who want to purchase and own property, it's going to make things harder, which is going to in turn push up pricing. So as this article points to, this is a very complex issue here. It affects everyone from the tax level to people working in construction to people getting laid off. So it's going to be interesting to see how the next little while plays out, but this is still going to be a slow market for the next, I would say, 18 months to 24 months. So if you are, looking at multiple properties, such as first time getting into the market or an upsizer, this is a perfect time for you. Unless you really have to sell and there's a life event, I would try to hold on for at least 18 months to 24 months to try to get a little bit value on your property. Even if you're selling at a little bit of a loss, which a lot of people are who've bought since 2019, you can definitely make things up on the buy. On the pre-sale side of things, we've had great success getting people assignments who can't afford the mortgage, as well as new construction projects that are sitting empty, new construction homes or townhomes that haven't been able to sell, getting them at a discount. I really wouldn't buy pre-construction unless you're getting a really good deal. But if you're wanting to talk through any of these scenarios, book a discovery call with me. It's in the QR code and the description below. But there's a lot of good value out there for buyers who have their financing in gear, and you can get something that is fantastic. And it's going to be really interesting to see how this plays out over the next 12 to 24 months. Until the next one, thank you so much.